The trigger event of coming to see you is the merger of CMA and CUA, which has occurred on the 29th of the month, so last week. We are now trading as a combined entity, $600 million of gross assets, about 460 market cap. On the current trading metrics, we're throwing off a yield on the current earnings for the group of about 7.5%, distribution yields of just under that, about 7.4%. Settled in really nicely since the merger. We had a 99.9% approval rating for the merger, so our investors, and a big turnout, so the investors have been very supportive of bringing the two vehicles together. Just the slide here is just showing you where we've moved in relation to our peer set, and one of the aims since listing has been to get to a size enabling us for index inclusion. You can see now from that size graph that we are well inside the index inclusion. Liquidity is still a little shy at around 25%. We need to get to 30%, and I think the trading that we have seen post the merger has started to pick up. So we are certainly lobbying S&P for our index inclusion at the next reset date being September. I think that'll be another catalyst for some price growth. Now we've merged and we are a much more diversified and a larger business. Our top 20 tenants now represent 42% of the REIT's income. You can see the strength of the covenants here on the screen. Diversification is all important in these income-based REITs to make sure that you're not carrying too much risk in any one particular area, and that is both in a tenant sense and a geographic play. And I'll talk about the geography in a moment, about the different markets that we are currently operating in. A graph here which is just showing you our progress since listing. And I guess over the last year, a steady rise in asset value, but also in equity value. The merger has now given us that critical mass that we've been seeking, and the fundamentals, the strength of the portfolio right now does lend itself to a good launching pad for further expansion and further growth. And I'll talk about that in a second. Just looking at our market place, so where we operate. Metro REIT, we operate in the fringe markets of the CBDs and out into the suburbs. And we've particularly gone into this place because it's a strength for Centuria. This is our breeding ground, and indeed where we have operated for over 20 years. So it's markets we know exceptionally well. We see right now a very hot real estate market, and you see that in the CBDs, the way that prices have been inflated, foreign capital coming into the country, driving ever lower yields. Yields that you'll now see in the CBDs 4.25%, 4.75% in the latest sales that have occurred both in Sydney and in Melbourne, leading the way, which takes me back to the late 80s, going into the 90s, just before a massive reset in pricing. What has occurred as a result of this is we've had a bifurcation of our markets. That the CBDs, I think, now are screening very expensive. The suburban markets, the yield differentiation is, as you can see on the right-hand side of the graph, running about 140 basis points. I think rather than see the CBDs contract further, what we'll see now is capital flow, which can't get set because of the tight yields in the CBDs, move into the suburban markets. And we're certainly seeing that here in Sydney, with North Sydney becoming the flavour of the month. The last round of sales, which are taking place right now, are being done at around 6% yield, when 18 months ago they would have been at 7.5%. They've come back in 150 points. I expect we'll see that come down another 25 to 50 points. And the further you go out, when you get to Chatswood, you get to Hornsby, Parramatta, or even when you're in Brisbane into Hamilton, Nunda and beyond, we still see evidence of new capital coming into the market, which will drive values and bring that spread back from 140 down to 120, maybe even 100 points. So there's still life in a hot market, but you have to be really focused on where you make that investment. I think we are indeed well placed, being in these markets, to find the value. If I look at the markets around the country very briefly, Sydney is certainly the hottest market going around, and going into the suburbs. The suburbs are being fueled by the amount of infrastructure spend from the New South Wales government, taking away stock because of the metro line. A lot of commercial stock has been removed from the market, therefore by default increasing commercial demand for the fewer buildings that have been left, coupled with residential conversions. And this is a theme right across the eastern seaboard, residential conversions of older B-grade assets into new resi or knockdown and rebuild, again putting a crunch on available space. Therefore tenant demand has or tenants are being pushed into the remaining buildings. So it's not so much about expansion of tenants, it's withdrawal of stock, which is creating the need for the excess lease inquiry. Metrics aren't right yet to build new office buildings. As such, then rents are growing quite significantly. We're seeing rental growth in Sydney suburbs north of 7%, going through 10% now, and incentives falling dramatically. Incentives a year ago inner suburbs, Chatswood, would have been 32, 35%. Today, down at 20% and falling quite dramatically. So real rent increases are north of 20% overall because the effective rent that is being achieved. Melbourne's suburbs have always been well in demand from the private capital, mixed now with institutional capital. And the differential yield between CBD and suburbs is only 50 points or thereabouts in Melbourne. So very hard to find value propositions in Melbourne. Brisbane, we think, has passed its low point, and as such, we're quite bullish in Brisbane. Our portfolio is just over 40% weighted to the Brisbane market as a result of the CUA merger, where over 70% of that portfolio was based in Brisbane. But we're comfortable holding what we have. It's well leased, and that's the key in the softer markets, is make sure you've got income to get you through the next 3-4 years. And while the markets are soft, you're still holding positive income. Looking at the smaller markets, and this is what I guess we would pride ourselves on, is looking for the early trend signs. We saw it in Canberra a couple of years ago when we bought into the Canberra market, when everyone's saying, gee, Canberra is a dead market. Now it's the flavour of the month. Everybody wants to be there. And we've experienced in excess of 20% growth in our assets in the Canberra market. We're now looking into the Perth market. I'm buoyed by what I see there, that whilst the overall vacancy in Perth market is circa 20%, if you get into the suburbs, it's about 16%. The worst that the Perth markets have been, and again we go back into the early 90s, when Perth was sitting at about 35% vacant, and it was a nightmare. What we see today is the completion of the last wave of buildings, which is the Woodside building just being completed at the moment. After that, whilst there's plenty of land for development, the metrics don't make any sense for the building of new buildings. So what we've got is now a stabilised market. But here the key is having income, having strong tenants. Maybe you pick buildings with tenants outside of the resource industries, and to that end, if you can find assets which have 5-6 years of known income coming through will ride through the lull that we're in right now, and certainly in the next 5-6 years we'll see that vacancy be absorbed and ready for the next cycle. So Perth is certainly our view spot. We've had an investment into South Australia. We've done well there, but we'll probably be exiting the South Australian market over the next 18 months or so. It's hard to find what the drivers will be to keep that market going. We've done exceptionally well in leasing and getting our building in Richmond Road leased to a consortium who are building their submarines. But outside of that, it's a daylight to find other tenants in that marketplace. So we've been active, we've succeeded. It's probably time to start to pull back out of that marketplace. For the Metro REIT, our overall aim is to make sure that we have our largest exposures to the strongest market. So we're still very much an East Coast investor, but we will always look for the opportunity for outperformance, for capital growth, where the research shows us that there is more opportunity for risk to the upside than the downside. And that's what Perth screens for us right now. So maybe 10-15% of our capital base over time we'll see into that Western market. And then we'll balance that with long-term leasing on the East Coast. The REIT market itself has had a tumultuous year. We were up at the beginning of the year. There was a softness through the middle as the markets adjusted to increasing bond rates. The last month has been a little soft. But when you screen across the REIT sector, the large caps look well and truly fully priced with income yields around the 5%, 4.8 to 5.2, that sort of mark. Then you come into the smaller REITs, or the more recently listed REITs such as ourselves, and you'll see 200 points additional yield coming into the 7.5%, with what I think is investments in the area which will certainly support further capital growth.